Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. We're going to dive right in, take a look, see what's going on. If you want to follow me, it's at Finance Square Finance. And if you want to join our community, finding-value.com. I dive deeper into all these topics, looking for potential investment opportunities. I do midweek updates. We do question and answer sessions on the weekends. The next one is on Saturday at 7 a.m. Mountain Time. If you'd like to join it, I do tape all of those and put them on the website. You can look backwards at old ones and see how well I am performing. So coming down, we've got Peter Krauth. He says silver among best performing assets to end October in 2024. We've got silver up 42%. Gold is up 33%. NASDAQ is doing quite well along with the S&P 500. And the one that is doing the worst is Brent crude oil, and commodities are lagging. What I'm seeing in the charts is commodities are about to take off, and I think the opportunities are the ones that are underperforming at this time this year. I think that we are breaking out of patterns. I can see it in coal. I can see natural gas is starting to firm up. Oil, we'll see where that goes. I don't. It's not broken to the upside, but I'd find it real hard to believe that we've got positive signals on agricultural companies, on other energy related equities going up, and that it wouldn't follow. So I find that hard to believe. But I think the opportunities are in oil and commodities, and gold and silver are still good. But I typically don't make new purchases with stuff that is up that amount that quickly. I still think it can go higher, but I go after the stuff that's people aren't looking at. In commodities and Brent crude, no one's looking at that. There's a lot of sectors that no one is looking at that I think are an excellent, excellent opportunity to purchase for long-term positions. Michael says, Stan Druckenmiller, this is an interview that he has done, and a lot of people, I guess, really like this interview. He doesn't really say anything different than his previous interviews, but what his opinions are: no material signs of a U.S. recession. Inflation may not have peaked, deregulation and tariffs. Never invest in the present, always look outward 18 to 24 months. He's bullish Nvidia after grads went from crypto to AI, and he wakes up at 5:30, drinks coffee, reads all of that stuff. I listened to that interview. He talked about a couple of setups that he did really well in the bond market. Basically looking at economies and then looking at interest rates and then taking very large bets off of what he would consider to be a disconnect between the economy and interest rates. And then looking at certain currencies that he noticed and interest rates and currency differentials. So he played some of those with a lot of money and I guess made out quite well. Peter Schiff says the Fed cut interest rates by 25 basis points, claiming they're confident they'll achieve their long-term inflation target of 2%. Powell can't possibly believe that, considering a 36 trillion national debt and the prospect of 2025 tax cuts sending demand and deficits soaring. Well, that's Peter's opinion on it. I think that inflation is still here. I think that there's nothing they can do about it. I don't think there's a single thing they can do about inflation. I think it's all based off the design of our currency system. So the question should be, well, what's the design of the currency system? Our currency system is loaned into existence. That loaning has a percent interest rate attached to it. So when the Treasury loans money from the Federal Reserve, you pay it back with interest. That is the bond that they create. So there's an exchange there. Whenever we have this system, there isn't enough currency, base currency, to pay back the interest in the system. So it is impossible to pay back the debt based off of the design of the system. So what happens is there's far more interest payments in the system than base currency in existence. What ends up occurring is that the banks continue to lend money to borrowers in the system against real assets. At some point, the system cannot take on any more debt, and all of those assets that have loans against it will go back to the banks. But the banks technically didn't put up correct collateral for it. And I don't care if this goes to the Supreme Court, because those guys are all um, jaded and bought out by the parties. But the banks making book entries, in my opinion, did not put up correct collateral against those loans. And if the Supreme Court would side with logic and ethics, they would state that the banks didn't put up correct collateral because they didn't put up correct collateral for all the loans. They did it individually, they might have. But collectively, they don't have enough currency to cover all of the loans on their books. And that's why they have such low reserve ratios. It's basically zero today. So technically they're bankrupt and they don't have the reserves to make those loans, which then means that they didn't put up correct collateral because they were fudging it. They were doing incorrect accounting. And if that is the case, that means that if people default on their loans, they should not go back to the bank because the loan that they put the collateral for should have never been, it's bogus collateral. And what I'm trying to describe is that the banking system ultimately doesn't put up the collateral against real things against this world. And what that means is that if we default, the people in the system with mortgages, that the banks end up owning everything. But they didn't put up the collateral to get it. They put up fictitious fake currency that was created from nothing and then put a bond against it with interest payments. So the whole system is a joke if you look at it. And the fact that most people they don't even know about the entire currency system. Once you figure that out, then all you do when you figure that out is you transfer those jokes, pieces of paper for real things. And that's all you can do. You buy metals, you buy assets, you buy houses, you buy whatever is physical. Christine Guerrero says, very astute. The Permian will have burned through all of its best acres, and OPEC's spare capacity will be back online by the end of his term. By 2028, we'll be scrambling for barrels globally with weakened storage reports. She is correct. And I hate to tell you guys, but drill baby drill doesn't mean anything. We've already used our tier 1 areas. We are going to go into tier 2. We are going to see a decline in well productivity. So each well that we drill, we're going to start to see less and less barrels come back. The costs are going to skyrocket, and they're going to continue to print money at a faster pace than we can produce oil. And oil is the balancing factor of money creation versus gross domestic product. Because gross domestic product is and has an R squared value of 99 point something percent or 98%, which means that basically GDP is oil consumption. And oil consumption, if you are constrained and they print money at a faster pace than oil, that is inflation. And it's all going to come out. And it doesn't matter who the president is because if I can come out and I can say, we are going to practice on increasing your vertical. And then I'm going to make a claim that this person has a 120-inch vertical. And you just say, well, that's not physically possible. Like no one jumps 120 inches. That's kind of what I'm saying when he says drill, baby, drill. Are you sure you got the oil? Are you sure you can increase it? Do you have the acreage? And what cost is it going to cost to get it out? There's no way he's going to bring oil down to the $50s or $60 per barrel range. There is no way. We're going to 100, we're going to 150, we're going to 200, maybe not on his watch, or maybe on his watch. And it has everything to do with money creation in relationship to the cost to take this out of the ground. And then it becomes a flow rate problem. So it's not about dollars, it's about physics and mathematics. I can't transport myself from A to B, which is 100 miles away, in less than 1 second. We don't know how to do it. And just because you throw a bunch of money at it doesn't mean that you'll be successful at figuring that out. It might take too much time. We might not have the flow rates. There's a whole bunch of things. So just keep that in mind. Scenario question. The fiat system today gives governments and central banks latitude to respond to crises, recessions, wars, and other destabilizing events quickly, though. Expanding money supply, adjusting interest rates, borrowing heavily. Would you be willing to give up the safety net in exchange for economic stability and discipline through crypto-based, hard asset-based currency systems? This is not the correct statement. The fiat system today does not give governments and central banks latitude. They are the ones creating the problem. The root cause of the destabilizing events is the currency system. So the question that is written here is written incorrectly. It's like saying that I'm trying to think of an analogy off the top of my head. That would be the same thing. I can't think of an analogy that would be better to say that. It's almost like, um, no, I don't want to say that as an analogy. The expanding money supply, the adjusting of interest rates, and borrowing heavily, uh, the destabilization comes from the currency itself, and it comes from the expansion and contraction of the currency. If you constrain the expansion, you will not have destabilizing events. And then on top of it, the events are things that people like to blame, but the events are actually tertiary outcomes of the boom and bust cycle. So expanding money supply is the problem. It's the root cause. It's the expansion of credit in the system, and there's nothing backing it to slow that expansion. And that is the problem. It's credit creation at a faster pace than you can grow your GDP, and that is AKA inflation. And then when that goes through, the demographic or the credit expansion, basically it's bank balance sheet credit. It's entries in a bank balance sheet to create loans. That's what it is. And that's what I was talking about earlier, that they don't actually have the money. They're just expanding the money supply from nothing. That is the root cause. That's what's the destabilizing in the system. They are full, the person who wrote the question, I think is that Mike Maloney or somebody? I don't know. Could be Mike Maloney. He doesn't understand, in my opinion. I would take an opposite thing. I would say the currency itself is the problem, not what he's saying here. Ordered on Trump's drill baby drill plans. Trump may open federal land for exploration, yet licensing, exploration, and production timelines, especially for conventional oil and gas, are multi-year processes extending beyond a single term. There is very little unconventional production on federal land. As such, rapid increases in production from this source are unlikely. So drill, baby, drill. Good luck. Good luck with that. Freight futures AM update. We've got dry bulk. Capesize is up 4%. Panamax is up 1%. Tankers VLCC is down 2%, and Suezmax is down 4%. Grady says massive inflection point in the markets right here. Could see one of my everything but USD and yields up moves from here. Have been posting remarkable charts at the service showing enormous potential for many sectors. Fed FOMC today in hours. US dollar could roll over right here, and I agree with that. Roll over the dollar, everything else goes up except for dollar and yields. And that's going to be from the Federal Reserve pushing that stuff lower. Inflatione is what's coming, and they're going to try to hold and control these markets. Eric Nettle says global oil inventories, both in the US and globally, remain at their lowest seasonal levels in modern history. Demand, despite a weak yet improving China, continues to hit all time highs. The setup for 2025 is more bullish than consensus, in his opinion. And he's just showing that global observable inventories are lower than any of the 5 years preceding us. And we've got US commercial crude oil inventories, excluding SPR, almost, I think that's at the lowest level that we've got. So here's my question. If we're lower than 2020 and 2021 in our inventory levels and demand is at all-time highs, why aren't we priced higher than 2020, 2021? If we have lower inventory, I mean, shouldn't inventory levels be commensurate with very high pricing? I would think. But we are lower, and that's the situation we are in today. U.S. commercial crude storage is at a 5-year low for this time of this year. 5-year low. And that's what I'm talking about with potential upward pricing, and that's what he's alluding to. Dan Su, whatever his name is, says peak oil demand keeps getting pushed out. What we're seeing today is that peak oil demand is about 10 years away. The unfortunate thing is, we said 5 years ago that peak oil demand was 10 years away. So if it's the 1024 tweet moving peak oil demand higher and later will be the craze for 2025 outlooks. Let me tell you something. I don't know if we're ever going to have peak oil demand. I think we're going to produce oil and we're going to use every single bit of it until it gets priced out of the system. And if we get priced out of the system, I think that we could potentially see problems with population. Like that's kind of my thought process. Oil's been the driver of everything. Coal, oil, and natural gas. Uranium has an impact too, but it hasn't been the main driver because we produce something like 10% of our electricity from nuclear. And we're going to have to go more nuclear, period. And we're going to use every drop of oil that we got because that's what the system is set up for. And I don't know if we have anything else that will work. Human beings have never created energy from nothing. We've always been able to gather it from our surroundings. The highest concentration of energy that we can gather from our surroundings is oil, natural gas, coal, and uranium. And everything else is at a lower energy density. We can gather that, or it's not even us gathering that. The earth naturally gathered those and put them into pools of energy use. So they're already pooled together. We can take it out and they're easy to store. Everything else is a complete disaster. Storing electricity, total pain in the butt. Collecting solar is far less efficient than the stored energy that we get from oil. I mean, I hate to say it, everything in this earth is stored energy from the sunlight. If we use dead trees, dead whatever, carcasses, just carbon-based things, that turns into oil and natural gas and whatever. The earth naturally gathers that up for humans, we could say. Maybe not for us, but it naturally gathers into pools. And then we extract those pools and burn it and use it. We haven't been able to figure out anything else. That is it. That's like the biggest summation of what I've learned from a lot of this. Now, fusion, that's out of ways, and we'll see if we can do it. Okay, so we're coming on down. We've got Jesse says silver was slammed in 10 out of the past 13 trading sessions. Always in the morning, always to the downside. People are trying to gaslight me into believing that's perfectly normal and organic behavior. And I'm actually the one who is just imagining things. Well, no, it is being manipulated. It has to be manipulated because it's not random. You can't always come out at a certain time, hit it down, on a downward move like this, at the same exact moment every single time. That is a program doing it, or something is being told to do it at a certain time. It doesn't exist. It's being manipulated. I agree. It has to be. There's no way that this is just random. Oh, random, 10 days in a row, all at the same time. Yeah, right. Called the agriculture bear market low back in June of 2020, and that's a proper call, not some vague question mark thing. The narrative now is that inflation is backing down. That is not what the chart is telling us. Get ready, need to compensate for what is coming. Shoulder, head, shoulder, potentially a breakout in DBA, the agricultural ETF. And I'm seeing stuff very similar to all of this. Everything looks really good to break out in the commodities complex. Fertilizers, coal, everything, nat gas, TTF nat gas. It all looks good. A ton of opportunities are right on top of us. Here's another one. Silver and sugar track each other very well, big picture. Silver broke out into a resumed bull market Q1 of 2024, as posted on real time. Sugar looks ready to follow silver. Sugar breaking out from a 44-year pattern is not good for food prices. Now, I don't eat a bunch of sugar, but these two are correlated and they're all breaking to the upside. Do you think that this is just happenstance? No, we're going to go into some ridiculous inflation coming, guys. I hope that everyone's prepared. It's coming. It is coming. Latest comparative inventory analysis using EIA data through 11/6/2024. Total commercial petroleum stocks, excluding other oils, we built 3.7 million barrels week over week. The WTI fair value calculated at $85 a barrel, or $13 undervalued at current prices. That's the dot plot comparing to history. And that's where we're going to end it. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website and get that Mayday coupon code if you'd like to try it out. We've got a question and answer session coming up on Saturday at 7 a.m. We'll catch you there. Catch you next time. This is Finding Value.